Our third speaker is Dan Rubinfeld.
Okay, thanks. Thanks for bearing with me. The work I'm going to talk about may end up in a similar place, but it comes from a different perspective, and it's based on work I've done largely with my co-author, Robert Inman, from the University of Pennsylvania. And our perspective is primarily normative, and it's from the perspective of an economist who thinks a lot about political economy. So the way Inman and I think about these normative issues comes from a very strong leaning towards a federalism view, a view that says that other things equal, there's an advantage to decentralizing authority, and in fact, if possible, there may be reasons to rely on markets and not on government intervention. And so we tend to think of a strong sort of centralized unitary government as the least ideal setting, and one which is and really follows principles of subsidiarity to be an ideal setting. And the question becomes, in the context of the Eurozone, the question becomes, what's the best way to manage economic shocks that tend to be shocks that are correlated with particular member states? And our approach basically starts off by asking, what is it about the market that's failing to resolve these problems? So it may seem surprising to start there, since I think I will end up at a place that's not very different from my colleagues, but I think it's instructive to go back and ask ourselves, what is it about market forces that make them unlikely to work? Because if you have an economy where you do have a labor market which is functioning well, where there's highly mobile labor, and you've got a capital market which is functioning well, and unemployment is caused by shocks that are pretty much uncorrelated across member states, then there may not be a need to have a fiscal union of any kind, because the market may in fact resolve a lot of the problems. Movements of labor, flexible wages, things of that kind will solve the problem. Well, we're obviously pretty far from being there in the US, which is my primary experience, and probably even further from being there in Europe, as I understand it. So it's pretty clear that the private sector is not going to work. There's limited labor mobility in Europe, and there's still some capital restrictions, as I understand it. Now, we might ask ourselves whether private insurance markets might solve the problems of these economic shocks. But and in an ideal world, that might work as well, because you could imagine, in the ideal, designing insurance programs that avoid moral hazard, or at least have sufficient co-insurance aspects that limit moral hazard, and you can imagine labor management coordination across the entire set of member states that would allow wages and employment to respond pretty well to these economic shocks. But the fact is that we're not any place close to that ideal, and so we're going to end up having to think pretty hard about what the role of the center ought to be. So again, I began by asking whether Keynesian deficit policies might work at the Eurozone level, and I'm actually going to think about what might even happen at a sub Eurozone level. And here, part of the problem arises because if we're talking about the actual current Eurozone, or even actually for that matter the entire EU, it's not anything close to a closed economy. So there are going to be significant impacts that occur outside the Eurozone and outside the entire EU. And so this means that sort of traditional Keynesian policies are going to at least have limited effects. They're not going to be as powerful as they might otherwise be. Essentially, particularly trying to deal with deficit spending at a member state level is likely to generate substantial spillovers to other member states. Now, I think I've got this on the next slide, but I do think that moral hazard is a serious problem. At least evidence I've seen in the U.S. historically supports that. If some of the effects of the shocks were fully capitalized into the market, maybe this wouldn't be a problem, but I don't think that's typically happened. And secondly, we have kind of a political moral hazard problem. If these economic shocks are highly correlated over time so that they're hitting certain member states and not others, you have the problem we've heard about earlier from my colleagues here to some extent, which is that the member states, in fact, might become politically dependent on these bailouts. And if you don't have the right set of rules at the center, you're going to end up seeing strategic behavior, which will undermine any attempt to make Keynesian-type policies work. So I've actually gone further in my own thinking, in the US at least, and asked whether we should, before we go to a strong centralized fiscal union, whether we could have localized Keynesian policies. My example would be California. Work I've done in the past suggests to me that, to a large extent, the economic shocks that have hit California over the years are reasonably localized. There are effects outside California, but they're not that huge. And you can imagine if California were to institute a more coherent set of fiscal policies, that it could manage a pretty good local stabilization program. And by that I mean, for example, having a serious rainy day fund where budgets were balanced over a business cycle rather than on an annual basis. I should say, by the way, that as most of you know, most U.S. states do have budget constraints, but they're not always very binding, since the budgets are sort of balanced balanced ex ante, and there's been a lot of debt that's accumulated even in states that do have budget constraints. Now, I've also asked myself whether some of the automatic stabilizers that we have might help solve the problem. We have progressive taxes and so on. We have transfer programs that respond somewhat to these economic shocks. But studies that others have done over the years suggest that automatic stabilizers are doing at most 50% of the job and probably a lot less. And I suspect if we were to move to fiscal union in Europe, that story would be true as well. So I think thinking for localized policies, by that I mean sort of perhaps having separate policies for some of the southern parts of the European Eurozone and maybe separate policies for some of the northern areas is unlikely to work. And coordination among member states, even at the sub-EU level, is not likely to work very well as well. So I've now taken about half of my time to explain something you probably all believe to start with, which is if the EU is going to continue to deal with these shocks, they really do need a fiscal union. But I think you need to ask yourself, if there is going to be a fiscal union, which is going to become, in John's terms, a transfer union to some extent, whether those transfers should be member states specific or individual specific, person specific. And there are advantages and disadvantages, as I see either way, but one of the advantages of member-specific transfers is that you avoid some of the moral hazard type problems we were hearing about earlier in the session. You don't have the kind of strategic response that member states might have to becoming coming used to to bailouts and responding accordingly. So this raises the question as to whether this fiscal union, if and when it's created, should begin by designing person-specific unemployment insurance type programs. And the advantage of such programs are several, one of which is that if the shocks are creating structural problems that are not going to be solved by market forces, there's a pretty good case to be made for designing these person-specific insurance programs. And separately from that, by the way, the programs, as many of you know, these insurance programs in the U.S. are designed at the center, but pretty much run by the states, and that sort of fits the theme that I will end up with. Now, I've also asked myself, what about progressive Eurozone taxation? What about progressive grants to governments? And I think there's a tension there, again, as to whether the program should be directed to the individuals or to the states. And I think ultimately the fiscal union will have to really do a combination of both. Now, in terms of managing such a fiscal union, My view, based on my experience, which is related primarily to work I've done in the US and also work I've done with the World Bank and others in designing South Africa's fiscal system, convinces me that the center in such fiscal union should play the role of designing programs. Again, this is very similar to what I think I've heard from my colleagues. Designing the programs, setting the standards, and really tying the hands of the member states and the unions. But the center is not best equipped to actually manage these programs. And that's partly political and partly economic. The politics is a problem because the center is likely to be subject to universalistic forces that will end up meaning giving benefits to a lot of member states without really enforcing the standards. And the management problem arises in part because the center is not usually the best equipped to know what the particular concerns are of the individual member states. So an ideal fiscal union, in my view, will first consider significant transfers at the individual level rather than at the member state level. And secondly, member state programs will be designed to have flexibility, some flexibility to allow differences across member states within the confines of a structure that would be set by the center. Now, where this leaves us, and I should say again, in South Africa, the country I probably know the best, when I was designing or helping to design the program, that's exactly what we tried to do. South Africa has a very strong set of rules that were designed by the center in Pretoria that govern how funds are transferred to the provinces, and it has a very active, progressive personal income tax system. But the actual management of most of the programs is done by the provinces or even at the sub-provincial level. And this has, for reasons I won't bore you with here, this in my view has helped, to today at least, has helped the South African fiscal system to manage itself very well. So member states have a lot of authorization but to do things, but under a set of rules by the center. Now the final question is the one some of you hopefully can answer better than I can, which is, will the politics of the center generate a solution that would be workable, that will look anything like the system I've sketched out? And there others know more than I do. I'm pretty skeptical as to whether it will get any place near what I've been thinking about. But on the other hand, I was skeptical that there would be a European Union in the first place. And one more thing before I go on. So the other issue that I just want to mention quickly is, and maybe it's obvious, a solution of a fiscal union has got to be broader than the current members of the Eurozone. And just because of the externalities that arise and because other members will be in the Eurozone at some point in the future. And so the politics of how we get there and how we deal with the UK, I think are interesting that go way beyond my particular expertise. And so finally, if you're interested, I just have posted 3 articles that I've written over a decade ago, and it's always embarrassing when you're around long enough to see that you've made predictions. So if you want to embarrass me, you can go back and look and see which things I was right about and wrong about, but I will leave that to your own time. Thank you very much.
Okay, thanks, Daniel.